You see here this bigger structure high, and before the market is reaching it, we have very high trade qualities. That means we see the market does enough length. We see that we have a very tight stop placement that when adjusting here $100 just within a green candle, you see here $500, $800, $900 up here, works here, works here, works here, works here, right? So you see now right now 2, 4, 5 times, 6 times, 7 times, by the way, red and green candles, just green candles that when adjusting $100, that those are $700, $800, $900 in average, trading up to this high here. While when the market has reached this bigger structure high already, the market is going very high, likely to wiggle around. We don't have that high quality anymore using the 1 minute chart. And the trade quality just got decreased by 5 times. Because the market has reached the target, it doesn't need to continue to push, or more likely it's not going to push anymore too much. And the market is starting to wiggling around. That means we cannot just take any green candle to trade in that direction. Now what we need is a red and a green candle in combination too much, and to place it so outside as possible. That means we need to see that the market is literally drifting up, stop placement here. And again, drifting up, stop placement down here. And you see here for 3, 4 times, we would have needed to enter here a trade that the market goes out because it's spiking 4 or 5 times down and then it goes up because the market reached already this goal. So again, with trade quality, very important that you understand. We have first the first impression here. That means when the trader here started trading, you can see how he made a picture in the beginning that he said, I'm seeing the market is going here to number 1. And then afterwards it was confirmed that the market did not reach number 1 up here, the target, what he assumed where the market was going at. And the main reason was because when you just look at it, you can see here the market is wiggling around, right? You can see here the market is wiggling around here in this area. And very often when you draw in this consolidation phase, you see here how the market struggles here, how it struggles here, right? So to assume it will go more than that is a bit hard. It is what the market is sometimes doing if it's at an all-time high with the experience. And I think that's why the first impression was good. It's just that the trader should have understood that here's this bigger structure high, here's a medium structure high, and we trade until this reference number 1 here. And then we understand that we now need to see that the market is pushing enough up to go to reference number 2. On the practical side, we want to have high quality trades down here, because if the market, if we are at area number 1, it doesn't matter if, let's just say this is target A and this is target B. If this is area number 1, when we have an entry here, we can manage our trade and let it run up to number B. This is totally fine. If we have trade quality number 2, because the market reached already our goal, as we just talked about it, you see just how the retracements, the length is not that much anymore. The market starts to wiggle around. So it's very dangerous trading here. And number 3 is when the market surpassed this, is up here, trade quality number 3. This is what might suck. It depends. If we see enough pressure, it's good. But on a majority of time, trade quality number 3 is just, I think, not worth it. It means we're trading with smaller amounts. I think it's good to have trade quality 1 and 2 and 3. But when trading with higher amounts, trade quality number 1 is beating everything, because we see that the market is going to certain points. Like literally, when we have the first impression and we tell ourselves, I'm seeing the market is going up to this reference, for example, I think it makes more sense, of course, to trade also to this reference. Keep in mind that you understand this one, is that when you assume the market is going here up to 643, if you assume here, look if you have before some other goals like here or here targets where you can assume the market is going at. Let's just look at 643. You can see here 643 is, by the way, what the market also was going at. So you see here 643 is literally here. It's just this high here, as you see here. It's just this high here because the spike here the market didn't do. So you see the market was going to 643 here for the first time. Then it was going down. And then it was going for 643 again. This area here, by the way. The problem is just that after the market did this spike and this high here, now we have this high here, we have this high here, and then we don't have this 643 anymore because it got broken down. So now it's literally about to understand that when we see the market is going up, trading to our first reference, and after the market reaches it, it will just be harder to trade there. So let's just take a look at the trading opportunities that you see that. And when even seeing the market is going down, I think it's to prioritize the movement up, because from here to there, this is a 5,000, 7,000, 8,000 leverage move, by the way. And this one is just a $3,000 leverage move. And the thing is, if you have time to sit down on a computer, we prioritize the bigger move, because the thing is, check this out. The color switches of green and red here when trading here are very hard to see that they're working. You see here the market is just wiggling around because it's just in the middle is very important. And it's not pressing that much out. It's very hard to trade here. The only green and red candle we have here is here that gave us a risk reward ratio of 5. But check this out. The traders saw that the market is going up. So here you see red, green, 1 time, 2 times, 3 times, right? 4 times, 6 times, 7 times, 8 times, 9 times here. And it's just very important that you understand that just alone you see here 5, 6 times that when adjusting $100, this is around $500 trading here. Here it's a bit already too late with this one. So you have more trading opportunities trading in that direction. And you need just to understand, you will not have this every day. You will not have this every hour. You will not have this literally like every 2 days. You need to wait sometimes a second, a third, or a fourth day. And this is a trading day, and this is totally normal. But it will be absolutely worth it, because as you see here, the trader already saw on the first impression before the market even did the move that he better concentrate on the move up. It's better to expect, because he has now 3-4 months trading experience. By the way, on the left side, you can see here also a trade of him, how he adjusted here $100 and made $800, I think, with this trade. $500, $800 it was with this trade. And it's just important that you understand how big this first impression is by trading in area number 1. You see here this bigger structure high. He did the trade before the market touches this high here, and then afterwards we can let the trade manage and run and just exit here our trade, or even when being later, when having the first $5,000, $20,000 earned, I think like it's good to go also into longer trade management with the smaller position size. But the bigger the position size, the smaller the management, I think, because of the mental side. Because on the mathematical side, it's always about with money management to grow account. What helps me out a lot, and also the trading student, is like if I have $1,000 and I'm losing 7 times, just in worst case, I would lose $700 because it's $100 on average. But if I make 3 times $500, it's $1,500. That means out of $1,000, we just have made $800 plus. That means, yeah, we almost duplicated the account. If we're able to make just 4 winning trades and then 7 losing trades, we made $2,000. That you understand here, 2,000 minus 700, $1,300. We duplicated. So the risk reward ratio is something what is very important. The trader here has sometimes a risk reward ratio of 1 to 5, 1 to 8. You need to imagine that's like a good average. I think 1 to 5 is just a very, very good thing, because it helps you to play also with the mental side, and it also always depends also on the market phase how it runs. So back to the topic. So trade quality number 1 is before the market reaches the goal. Trade quality number 2 is decreased by length and retracements. Very important. We cannot just take any green candle, because at number 1, we can mostly take green candles when we see the market is pushing up. We have risk reward ratios of 5, even 10 or 15 sometimes, and trade quality more or less. And the third one is when the market surpassed the market, trade quality is extremely decreased. What I want you to add additional is, by the way, the difference between trade quality 1 and 2 is decreased by 5 times. The trade quality to 2 and 3 is tremendously decreased already. So it is always about trade quality number 1, but I'm telling you something, and this is something that's very important, is that in the practical side, you can not only trade quality number 1. We need to take sometimes trade quality number 2 or 3, because there will be a couple of months, as of now, for example, June, July, August, that the market is just going up to trade quality number 2 or 3, and it's going to push enough. And the market experience, what the market is currently doing, seeing 20, 30, 40 trading opportunities a month, is this what will show you, is it right now working better to have trade quality number 2 and 3, or else we don't earn any money? Or is it better to trade quality number 1? No financial advice, just something that works out for me very well and the trading students. Hope it helps you out. Wish you all off good trades. JT out.